Today is September 4th, 2024. 25.
You're trying to
I want a
trick
new
us.
tax guy. So, the reason I mentioned the date is because the tax law is in flux. IRS is delaying making changes to tax forms. And some of the items that I'm gonna mention today may be different when we get the rules for filling out forms in February or March. Like, for example, IRS said we're not gonna update the W-2s or the 1099s for 2025, even though the law changes are effective in 2025. They basically told the software companies, figure it out. But we'll make those changes for 2026. So we'll have to figure that out. Remember, IRS has got less of a workforce. They're strained. A lot of experience has walked out the door for different reasons. And there could be a problem with tax season. I'm gonna say it differently. There will be a problem with tax season. So we'll work with that as we have to, but some of the items I'm gonna talk about may change, and we don't know how they're gonna change, and we're not gonna know what the changes are until the forms are finalized for 2025. Gotta give you a little legal disclosure. Don't believe a thing I say. So just remember, the purpose of this is to give you general tax information. I'm not giving information to anyone specific. All right, a picture is worth 1,000 words. Here is someone's reaction to the tax law. Notice he's got Form 1040, but doesn't tell you what year. So the president signed the tax bill July 4th, 2025. You're gonna hear it called One Big Beautiful Tax Act. You're gonna hear it called HR1 or public law, that's the PL 115/1997. It's the same thing. I'm gonna refer to it as a tax bill. So the tax bill addresses lots of things. I'm only gonna talk about a few. Some of the items that I'm not talking about is the overtime and the deduction for tax on tips. It doesn't affect no one in this room, so we'll leave that for another day. So what this tax law did is in 1997, during Trump's first administration, they brought down some of the tax rates. And then the top tax rate since 1997 has been 37%. If this law didn't get enacted, the 37 is going to 39.6. So Congress made the decision to not let it go to 39.6. The top bracket is still 37%. And what they did is they just adjusted the brackets for the 10 and 12%, made them a little wider. That's a tax help. A little. Take it. And then these brackets are indexed for inflation every year. This is like an outline of what the Form 1040 looks like. And I'm going to be referring to something called modified adjusted gross income. We're calling it just adjusted gross income. So in different places on your return, you report your income, wages, interest, dividends, capital gains, Social Security, benefits, IRA distributions. Then there's a Schedule 1 called adjustments to income, where you have some other income, and then you have some deductions. The other income could be like jury pay, which I'm gonna be reporting this year, because I served on a jury this year. Big $40. And by the way, they do things differently now. You don't get a check in the mail. When you get to jury duty, they give you a credit card, and you have to register it. And so I have a credit card at home waiting to use the $40. It doesn't even buy dinner today. So if I take income, And for many of you in this room, your income is gonna be your adjusted gross income. And the reason I have modified the M, modified adjusted gross income, that's the way the law is written. And I'll tell you what's the difference in a second. And then the modified adjusted gross income is used to see how much of these new deductions you're eligible to get. So adjusted gross income is all your income, including your taxable Social Security. Modified adjusted gross income, and I just mentioned that because it's in the law in 100 places, it's income from Puerto Rico, Guam, American Samoa, and the Virgin Islands. I had yet, in my 40 years of practice, I've yet to have someone have income from those places. But it's in the law, and I suspect it's in the law for a reason. It affects someone, it's just no one I know. And then we're gonna talk about itemized deductions and the standard deduction. I'm gonna go a little in depth in that. So the itemized deductions, you know what they are: medical, taxes, charitable, home mortgage interest. Those, some changes were made to that for 26, not for 25. And then there's standard deduction, and I'm gonna make a big stink about the standard deduction because I want you to know why that's important. And then you come up with taxable income, and then taxable income, you take that number and you go to the tax table to compute your tax, and that's where you compute whether you're in the 10, 12, 22, 24% bracket. Nothing new so far. So this is the standard deduction comparing 24 and 25. So what do you notice about 25? They're all larger. And Congress made them a little larger. And so for a single person, it's $15,750. Married, filing joint, neither spouse over 65, it's $31,500. And both spouses over 65, it's $34,700. This number is important because if my income, let's say I'm married, filing joint, and both spouses are 35, if my taxable income is if my income is 34,000, I get the standard deductions for 34,000. My taxable income is 0, even though I have income. So here's where the change comes in. So Congress is all the nonprofits noted that when charitable contributions were no longer deductible, or more people were taking the standard, there was a big decrease in charitable giving. So Congress said, okay, we can help. So if you don't itemize, and this is starting in 25, so it's already effective. Remember, they passed the law in July, and this change goes back to January 1. If you don't itemize, for a single person, you can deduct up to $1,000, and for married filing joint, you can deduct up to $2,000. This is just for cash. The non-cash isn't deductible. It's only deductible if you itemize. So for a lot of you, you have been taking the standard deduction because the taxes have been limited to $10,000, and for almost all of us that own a home, DeKalb, Fulton, Cobb County, and the real estate taxes have gone up, they were limited to $10,000, and that's going to change. So a planning point, like Kevin was saying, is some of you may be flipping, and some of you who have taken the standard may be itemizing going forward. And you don't want to know that next April. You want to know that now, because it may encourage you to make more charitable contributions. If you pay Georgia estimated taxes, you may want to pay the fourth quarter payment that's normally due January 15th of 2026. You want to pay it in December to get the deduction. You can't figure this out in February or March. It's too late. You can't backdate the check. You can't backdate the charitable contribution. So that's why the planning is important, even for simple returns for the next couple of years.
That's in addition to what?
In addition to the standard deduction.
Right.
So a married filing joint was $34,700, both over 65. If they donate $3,000 to charity, they can deduct additional $2,000, so they would get the $34,700 plus the 2, and then they may get the senior deduction depending on income. We'll get to that in a minute.
Henry?
Yes.
So we take the standard deduction, we have income from R&Ds. Is there any preference for this versus doing a QCD for a charitable contribution?
So let's go to the formula. We're going to do the formula. Okay, so if you have income from an IRA, it's income.
Right.
Okay, so, and then I gotta say something about the QCD, I'm glad you asked the question. So, if, let's say your R&D is $10,000, just to make the numbers simple, and you decide to give $4,000 to a 501c3. And remember, it's gotta go from the IRA trustee to the 501c3. If it comes to you, you broke the chain.
Right.
Okay, so then, starting this year in '25, another change they made in February, effective all of '25, is the QCD now is gonna show up as a new item on Form 1099-R. Before, you would have gotten the 1099 that said 10,000 gross, 10,000 taxable. It was on you to report the QCD on your tax return. This year, and the form hasn't been, they said they were gonna make the form, it hasn't been put out yet, there's gonna be a code that says you report the 10, and then you get taxed on 6, 10 minus 4.
Right.
So that helps reduce your income, okay? It helps reduce your taxable income and reduces your tax rate.
Right.
Okay. The question is, should you be doing QCD or itemized deduction?
Right.
And the answer to every question, it depends. So it may be good for you, and it may be different for him. Because it depends on your deductions and what else you have. Generally speaking, because the standard, you know, what's changing this year is the state and local tax deduction used to be limited to 10,000. It's up to 40,000. And a lot of you, me included, with the real estate taxes and the Georgia tax, I was over the 10. Regardless of what I was over the 10, I can only deduct 10, because the law limited it to 10,000. This year it's going up to 40. So you may be itemizing.
We don't have a mortgage,
Oh,
so.
That's okay, that's okay. So
Where do medical deductions, are they still a percentage of?
it's
your
still
medical
7.5%.
deductions?
It's still 7.5% of your, gross, adjusted gross income.
Yeah.
Harry, can you repeat this question, please?
Yeah, he asked about the medical deduction, is it still subject to a limitation? That has not changed, it's still 7.5% of your adjusted gross income. So if your adjusted gross income is 100,000, 7.5% is 7,500, and if your medical deductions are 8,000, you deduct 8,000 minus 7,500, your net medical deduction is 500. That may not be enough to itemize. So you have to do two things, you have to itemize and be over this, you have to have over the 7.5% and itemize. But again, that may change this year. So remember, just because you took the standard deduction last year doesn't mean it was a good idea to take it this year. Because of the real estate taxes and your state income tax could push you over. I just did a projection for a client who's been taking the standard, and I hit the box to apply the 25 tax law changes, and he's itemizing. I'm like, oh, I didn't realize he'd be itemizing. So he's got a fourth quarter Georgia estimate, so I'll be meeting with him next week, and I'll be telling him, pay the fourth quarter Georgia estimate in December, not when it's due January 15th. Questions? Oh, I want to say one thing about charitable contribution deductions. If I do your work, you know this, I always ask for it, is you need a letter of acknowledgement. That hasn't changed. You need a letter from the charity saying, I gave $500 to the American Red Cross, and the letter needs to say, I did not receive any goods or services in return. including from your churches, from your synagogues, from any 501c3. Nothing of that has changed. There was a tax law case many years ago where a couple made a $100,000 contribution to the church. The IRS was doing sampling around the country, and they asked for the letter of acknowledgement. And so the rules say you have to have that letter of acknowledgement before you file your tax return. So they called the bookkeeper at the church. She came up with the Excel spreadsheet and sent it to the client. The client sent it to the IRS, the taxpayer sent it to the IRS. No one looked at it until it got to the IRS. When the bookkeeper printed out an Excel spreadsheet 2 years later, it had the current date. The rules say you have to have that sheet before you file your tax return. So there was no question they made a $100,000 contribution to the church, and it wasn't deductible. Okay. That's why a lot of times, if you work with me, I make a big stink about those letters, because I want to see it. Questions on any of that? If you work with me, I'm not afraid to challenge you. And if you give away stuff to Salvation Army and Goodwill, and you give away household goods / junk that you don't want, don't tell me it's worth $3,000 or $4,000. I'm gonna cut it down. I'll call you, but I'm gonna cut it down. Remember, used stuff is worth a lot less. Just a word that, and IRS looks at that because there's a form on there, if you itemize form 8283, where you have to put this information. That's where they can get it. So, some things are good, some things are bad. This one's bad. Starting in 2026, you lose a portion of your charitable contributions by 0.5%, 0.005. And for some people, it's not a big deal, but if you're in the 35 or 37% bracket, it is a big deal. And so, what happens when you lose a deduction? Your taxable income goes up, and when your taxable income goes up, your taxes go up. So how do you get around this? If you're planning on making a major contribution, make it this year, so you don't lose it and you get the deduction. I'm not talking about the $100 or the $50 that I see, which is very nice that you make to a lot of the smaller charities, but if you're planning to pay a big contribution or want to give an organization something larger, do it this year. I thought this is awful. They're giving you the opportunity to deduct charitable contributions when you don't itemize, and then if you itemize, they come back and slap you. I don't see the logic to that, but that's the way it goes. You want to know this today, not next February. You want to know this today and not next February. It's too late to do anything about it in February. Some of the provisions I mentioned are effective in 25. This one's effective in 26. There's one thing I want to also mention. You're going to get a chuckle out of this. The tax law is permanent until Congress changes it. So that could happen in 27, it could happen in 28, depending who's president, depending who's in Congress. So this is what happens if your AGI is 0.005% of your AGI. So I just gave an example to make the numbers easy. If your AGI, modified gross income, is 300,000, you multiply that by 0.005, which is 1,500. If you contribute $25,000 to your charity, you deduct 23.5. You lose that 1,500. It's gone forever. So this is a way, like I said, the logic doesn't make any sense. On one part, they tell you, we're gonna, you know, we encourage you to make it so you can deduct it, and then if you make it, and you make up, and you have high income, we're gonna reduce the contribution.
Is there an upper limit to, to your gross adjusted income that this applies to,
So, right, you multiply your adjusted gross income by 0.005,
regardless of the amount of the gross?
and regardless of the sources, regardless of source of the So, one of the things Kevin was mentioning is doing a Roth conversion. Roth conversion increases your AGI. So if you make a charitable contribution and you do a Roth conversion, you've like not done much for yourself. You've caused yourself a tax increase. So there's a lot of moving parts. Returns that were simple are no longer going to be simple. And the other part that's going to be a little more complicated is figuring out the estimated tax payments for 2026. Okay, this is what you came for. So when Trump ran for president, he said, we're not gonna tax Social Security benefits. Well, that's not the way the law works, and that's not what was enacted. So what Congress did is they called it a senior deduction. So this is effective in 25. It's already effective this year for 25, 26, 27, and 28, until Congress changes it. So if you're single, it's $6,000 per individual. So married filing joint can get potentially deduction up to $12,000. That's in addition to the standard deduction. That's in addition to the charitable deduction if you don't itemize. So all these things pile up and they can help you, but you gotta plan for it before December 31st, not February 1st. So like everything in the law, there's got some limits. So there's a phase out of $175,000 for single and $250 for married filing joint. For a lot of you in the room, you're gonna get this. And I've already called a couple of clients of mine and said, don't pay estimates 3 and 4 because they're gonna get the $12,000 senior deduction. Remember, it's the standard deduction, could be the charitable deduction, and this. And there's no reason why, for a lot of taxpayers, they should be paying no tax if your income is like $100,000 to $125,000. So why did they put this in the law? Okay, this is effective already. It's buying a car and getting a car loan. So it's sort of, it just doesn't make any sense making this effective January 1st, passing the law in July, and you've already lost 6 months of time. And if you go buy a car on July 4th, you're not gonna pay $10,000 of interest for the rest of the year, most likely. So if you buy a car, and I'll tell you what a car is, because it's not what you think, you can deduct the interest up to $10,000. So in order to deduct the interest, there's going to be a place on the tax return to report the VIN number. This is another database to go to. Okay, so you see how preparing your tax return is gonna get a little involved. I don't know of anyone that's come to see me with a new car carrying the VIN number on, VIN number. They bring me all the 1099s, they bring me all the papers, I've never seen the VIN number.
It's in here.
Well, I hope so, you're gonna need it.
It's on your insurance card.
Charlie?
Does that cover leases?
No.
No?
It has to be, Charlie has to, if it works for leases, it does not. You have to buy the car. And it can only be for personal use, you can't use it for business.
So this-
And there's some more restrictions, which I'll get to in a second.
So does that, excuse me, I'm not following it. Is your modified adjusted gross income is joint, is over 200,000?
You're not
then
gonna
you
get it.
cannot
You're not gonna get it.
Right, okay, so there is a income limit.
Correct.
Okay,
Correct.
okay.
But pay attention, this is already effective for 2025 and half the year's gone when they pass the law.
Right.
So it's gotta be a passenger car, and I got more stuff on it to tell you. This is just some mumbo jumbo. The original use, you gotta be the original use. The car is regular car, it could be a minivan, a SUV, a pickup truck, or a motorcycle. Okay, and it has to have gross vehicle weight of $14,000, 14,000 pounds or less. You'll need that, the window sticker that you carry, that this gentleman carries on his cell phone. So if someone buys a car and has a loan on it, I've got to ask a lot of questions. Once again, no one has come to me and tell me what the gross vehicle weight is of their new car.
It's in the book.
Until now. And there's a website, and I have it, I just didn't put it on the slide, where you can go and see if your car qualifies to have the interest deducted. Okay, and I haven't said the most important thing. The car has to have final assembly in the United States. Okay, that's the purpose of the law. Now, just because you have a foreign car, like for example, I have a Subaru Outback. My car was built in Kentucky. So just because it's a foreign company, doesn't, you have to find out where the final assembly was. If I got my Subaru in '24, this year, I could deduct the interest. Because I would met the qualifications and my car is under 14,000 pounds.
So is that, you're paying for your car for 4 years, you can deduct that 10,000?
Yes.
It's each year?
Yes. So if you pay $12,000 of interest in year one, when the interest will be higher, you get to deduct 10. The only good news I can tell you is that's in addition to the standard deduction, in addition to the charitable deduction for people that don't itemize, in addition to this senior deduction. Returns are going to be very different for 2025 and 26. There'll be no such thing as a simple return. You got too many moving parts. So so this, I'm just gonna mention this briefly because it's in the law. This is awful. For taxpayers that income is high and gets taxed at the 37% bracket, they lose some of their itemized deductions as though we're in the 35% bracket. This is like a tax reduction. I mean, you lose your deductions, increases your taxable income. That affects very few people, but that's just something that they put in. And they encourage you to go get this, to get the income, and then at the back end, they're limiting the deductions. Okay, so Nancy, if the real estate taxes on your house was $12,000, how much could you have deducted in the last 10 years for taxes? 10,000, regardless of what they were, by law. People, when this law was passed in 1997, taxpayers in California and New York were up in arms. You can imagine, because in New York and in California, $1 million house is not a big deal, and the real estate taxes is a big deal. And they were limited to $10,000. And the $10,000 was limited to their taxes on their house, plus their state taxes. I've done a few California returns and a few New York returns. The state taxes are nothing to laugh about. They start adding up. I've had people that had $40,000 between real estate taxes and state taxes, and they got 10. That changed. It's going to change. And this one is good for taxpayers, so what they did is they made this effective in 26, not 25. Wait a second. I'm sorry, the SALT deduction starts in 25. Okay, so here's what I'm telling you. You may have taken the standard deduction for the last 10 years, and the taxes on your house, if you live in the Atlanta metro area, have gone up. And if you make charitable contributions, and I realize a lot of people here don't have a home mortgage interest, but the taxes may cause you to itemize. with your charitable contributions. Maybe you have some medical. So, you gotta plan. And remember, you don't plan in February. It's too late. You can only plan for 26 in February.
Will this cover rental properties?
No, that's separate. This is just for your principal residence. And you can only have one principal residence at a time.
I do now.
So second house is out, second home is not.
It's included in that new $40,000. So, like everything else, there's an income limit. This one's not too bad. If you're single or married filing separate, it's $250,000. If you're filing a joint return, you're at $500,000, the deduction starts getting reduced, and at $600,000, it's phased out. So it's good for the people that it helps, and you can't go below $10,000. But if your income is high and you have $48,000 of state, local, and real estate taxes, you may be limited to 10. But I do think it's gonna help quite a few people. And they increase the 40,000, 1% a year. And then if the law doesn't change in 2030, it goes back to $10,000. I suspect they're not gonna bring it back to 10,000 at that time. They'll probably increase it. And this is just going over the income phase out for the state and local deduction. So I'm just gonna switch gears for a second. Any questions on any of the tax items that I talked about? You got a plan, and you got a plan now. Getting all your information, all of your 1099s in February, it's too late to plan.
We can use last year's as an estimate.
Yeah, but you got to adjust for the new deductions.
Right, but I'm saying just as trying to get a feel for your
Yes,
income.
yes.
The one in Georgia,
Yes.
the one and two in identity theft.
Go ahead.
Are there any changes to the alternative minimum tax?
Not really. They left that pretty much the same. So that's okay. Before 97, almost every client that I did, it was subject to alternative minimum tax, and because they raised the exemption to $1 million, that very few people are subject to it.
And what's the rule on the generation skipping taxes?
There's been no change. I'll get to that in a minute.
Okay.
Anyone else? Remember, don't plan February 1st. You missed the boat. One of the items Kevin just mentioned, the generation skipping and the estate tax exemption, it's $13,990,000 today. Next year, in 2026, it's going to $15 million. Thank goodness it didn't come up with an oddball number. It's $15 million per taxpayer. For most people, they're not going to be subject to estate tax given those limits. And so what we hear from some clients is, I don't need a will. I don't have to worry about leaving any of that stuff because I won't be subject to estate tax. That's very, very wrong. You need a will or you need a trust, and you need one today. Because you are supposed to tell us how your property goes. Unless you want some arbitrary probate judge sitting downtown to decide who gets your property. And the only place to do that is in a will or a trust. And our office can help you with that. So just because you're not subject to estate tax doesn't mean you can drop the ball and not have a will. You need a will. Everyone needs a will. Wills are public. I can go get Elvis Presley's will if I want to. It's available because will is a public document. What's not public is if you set up a revocable living trust, and that becomes irrevocable when you pass away. And so what your will says, I leave everything to my revocable living trust, that's all the world sees. Whether it's 100,000 or 100 million, no one knows. But that's why you need the will for sure. And there's a $15 million generation skipping tax exemption. And that is the discussion for another day. That's a whole separate topic, and it gets a little involved. The number one tax issue affecting seniors in Florida and in Georgia is identity theft. Let me point out. You see how Florida and Georgia are a different color? Florida's number one and Georgia's number two.
So let me tell you about an example that happened to us this year. We wrote a check for our Georgia state tax, and it was never cashed initially, never showed up on the bank statement. 9 months later, somebody had the check, reforged the ink, put their name on it, and cashed it for $9,800.
Okay.
The bank immediately recognized that something was wrong, called us, refunded the money, and SunTrust, where it was cashed in Charlotte, went after the person.
Did you get a letter from Georgia though saying you're short on your payments for
I
it?
didn't.
Wow, really?
I did not get anything, which I went ahead and paid it, paid tax,
Yeah.
state, estimated taxes.
Right, right.
and covered it all. But I never got notice from Georgia.
Just gonna ask you a couple questions. Do you remember where that check was mailed?
Post office?
What post office is it?
Yeah, it was mailed to the Sandy Springs Post.
Okay, they're not the ones that had the biggest problem. The one that had the biggest problem, the one in Chamblee, Dunwoody, and Mount Vernon. That's where all the problems started coming, and it turned out it was an inside job. There's cameras there everywhere you go, and they couldn't figure it out. Well, there was
Fortunately,
like,
I had the check stub, and if you looked at it really carefully, you could make out Georgia Department of Revenue in part on the check. The bank was great. I mean,
no, that was
they really
good.
took care of it.
So I had a client.
So pay electronically.
Yeah,
It's
well,
a
I'm
lot
gonna,
safer.
I'm gonna get to that in a second. I had a client that had two clients, not related to each other, that mailed their tax and estimated tax payments on the post office in Chamblee, Dunwoody, and Mount Vernon. And they went inside the post office. They didn't mail it outside the blue box outside.
Yeah, I did that too. I really did.
So for both, he filed the return, and 3 weeks later, one of the clients called me up. He says, "Didn't you file my return?" I said, "Yes." "Why are you calling? Why are you asking?" He said, "Because Georgia didn't get my payment." So she was looking online, and she saw their check, and she saw the check that she wrote to Georgia had a different payee. She went to the bank. It was Truist, and to their credit, the next day they figured out who it was.
Truist Bank is where my check
Yeah,
was
yeah,
cashed.
and so they refunded her the money, that's all I was interested in. She got the money, then I asked her to come in the next day, and we mailed IRS the check. Another person mailed 4 checks, 2 balance dues, and 2 estimates, and none of those 4 checks cleared. He got a letter saying you didn't pay your tax for that year. So I had him look on his bank, say, the check's never cleared. I said, "How about looking one more month?" He said, "The check's never cleared." It's a problem. And I'm gonna show you, you probably already, you could probably help me explain this. So identity theft happens in doctor's offices, using credit cards, responding to texts that you get, emails that you get. Don't click on those links. Don't respond. If someone wants to contact you, they know your address, and they will send you a letter in the mail. By the way, IRS doesn't send emails and doesn't send text. It is irs.gov, not irs.com. That doesn't exist. Georgia's not bashful. If they think you owe money, they're gonna send you a letter in the mail. They're not gonna call you. They're not gonna email you. I haven't figured out why they ask for the phone number and the email address on the returns, because they don't do that anyways. But that's for another topic. So one of the things, did you get an IP pin from the IRS to pay electronically?
Yes.
So you can apply for this online. And so what you do is you go to irs.gov, And on the search field, on the upper right-hand corner, you put IPPIN. It's gonna take you to the website where you can sign up for a PIN number. It's a 6-digit number that you get either through the account or letter in the mail. I've seen it both ways. So Al, if you have a PIN and I e-file your return and I don't put the PIN number, the return gets rejected.
TurboTax gives you a PIN.
Okay?
Right.
So that's useful. You may have a PIN and your wife may not have one. Okay, you can request one, she can request one. I'd say you just need one between the two of you.
Henry, can you help avoid some of these problems if you e-file and if you pay via an EFT as opposed to writing a check and sending it through the mail?
The answer is I think so.
Okay.
Can't give you the assurance.
Right.
And why the PIN, the IP PIN you get is only good for 1 year. So if you get one for 25 returns, there'll be a new one for 26. There'll be another one for 27.
So each year you have to get one?
Yeah, and they will automatically send it.
Oh, they're in general.
Yeah, they will, once you sign up, they'll automatically send it. It used to be that you had to prove you had ID theft. But now they said, well, that's ridiculous, we're trying to prevent it, so anyone can ask for it. You just gotta prove your identity online. And I know for me, it's a little easier, because I can get into the IRS website and I have special numbers to put in. But not, you guys probably don't. But I think it's worth the effort to get one.
Henry, is this just relating to income tax? Because I keep seeing all these ads on TV about how people can steal your mortgage, your home, and everything else.
Yes, this is just for income tax.
This is for income tax. Yeah, but Florida and Georgia number 1 and 2, is that just for income tax, or is that for all these other
For
kinds
all
of?
ID theft.
All ID.
ID theft. And Georgia and Florida have been on the top 5 for quite a few years, for whatever the reason.
One other area we had, it happened 3-4 times, is when the credit bureau itself or insurance companies, kind of systems have been hacked and your data has been compromised. And then they offer you credit monitoring for a year or 2. But your data is still
Gone.
gone.
It's gone.
So how do you purge it out from the, what they call the black list?
You can, and you have to live like a hermit and not use credit cards, not use emails, not use social media.
Right.
Impossible.
There are services, there are services.
You go to the store sometimes and say, I'm gonna pay cash.
Right. There are services that you can subscribe to that scan the black web and look for your information and order it to be removed, which they can legally do.
Right.
Because to do it yourself is impossible.
Right.
There's so many of them.
Anyone here eat at Goldberg's restaurants, Goldberg's Deli?
Once in a while.
Okay, no cash anymore. You gotta pay by credit card or debit card. That's good and it's bad.
And did they charge you to use your credit card?
Probably.
Currency says legal tender for all debts.
But they don't have to accept it,
Fine, then I'll walk out
Well,
without
the
it.
solution I found, I just went ahead and froze my credit with the credit bureau. Nobody can open up a credit in my name.
But we'll put block on our
Okay.
credit reports, that's the best thing to do, to put a block on it, so
Freeze
that
your credit,
nobody
freeze your
can, yeah, so nobody can, but the other things with your credit cards and things like that, there's not much you can do about it.
Credit freeze thing has gotten a lot easier to use in
It's
recent
kind of
Yes.
scary.
So highly recommend it because it is easy.
All right, I'm gonna mention something that's gonna apply to just a few people, probably no one here, but I got a chuckle from it in the law. So if you go gambling, you have gambling winnings. Let's say I got $50,000 of gambling winnings. All right, good luck.
I'm gonna gamble with you.
So you can deduct the gambling losses if you itemize. Okay. Starting in, I believe this is starting in 26, if you have gambling losses, you can only deduct 90% of the losses. So So the people in Nevada are upset about this, and they've got a group of senators that are trying to get that part of the law changed.
How in the world do you show your losses? They're not gonna give you a 1099 for your losses.
No, but you gotta have the tickets,
Huh?
you gotta have the receipts, tickets that you bet on.
If you are a pinball machine.
Well, you know, you're playing poker, you're not getting receipts.
So-
You're doing the shooting craps, you're not.
Before I moved to Atlanta, I worked in Miami, and I had a client that was a cardiologist. And sometimes I had to figure out, did he spend more time, and he bet on horses. I had to figure out, did he spend more time as a cardiologist or more time at the track? Because his gambling winnings were $300,000 to $400,000 a year.
Wow.
Okay, so what he did is he used to go to the track and buy the film of the races. He would look at the horses, and being a doctor, he knew what to look at, and he looked at their structure like in the neck. And if he liked the way this particular horse looked, he bet on them the following day. And he did that for years. He's one of the few people I ever did their returns for that had huge gambling winnings.
Well, I had a friend who used to go out and pick up all the tickets on the floor.
That's why.
Take them to his account.
That's why.
what I bet.
That is why. So like I said, his W-2 from working could have been $250,000, but his gambling winnings were $400,000. And he did lose. But he always came ahead, and he knew the rules. He always brought me the receipts to deduct the loss.
So does that gambling deduction only apply to reducing your income by virtue of gambling winnings?
Yes.
Okay, so
But before this law change, if you had 10,000 in winnings and you had 12,000 in losses, you could deduct 10. You could never go below 0. Now you can deduct 9. So people in Nevada are saying, like, now we're getting taxed on money we don't have. It'll be interesting to see if that changes, because they have strong laws. So just to bring the point home one more time, there is no such thing as simple return anymore with these deductions for 25 and 26. You gotta get ahead of the game, and you gotta plan. And I can help you. But you don't wanna do this February 1st. It's gone, it's too late. You're welcome to call me with any questions. Anything else anyone wants to bring up that I didn't mention? And thank you.